All right, and we are live. Today we have with us Chris Grenzig. Chris started his real estate investing journey back in January of 2016 by attempting house flipping on Long Island, New York. Ultimately, that endeavor failed to flip a single house despite spending tens of thousands of dollars in several months trying. I'm going to jump in there, Chris, and say I feel your pain.
Mhm.
Continuing with the intro here, Chris and his team tried pivoting to purchase tax deed properties in Philadelphia, but quickly realized it wasn't for them. From there, Chris started to learn about multifamily and started by investing passively in an 8-unit property, then joint venturing on another 100 units worth over $4.5 million. From there, Chris quit his full-time job in finance and joined the Toro team full-time in August 2016. That is a great intro. So, Chris, thank you for hopping on the show.
Yeah, thanks for having me.
Absolutely. To get us started, why don't you dive a little bit deeper and tell everybody where you are, what you do now, and how you got started in real estate in the first place?
Sure. So you did a good, quick job of doing it, but Long Island, born and raised. I'm 28, and I like to start it. I graduated college in 2014. I was a Division I soccer player at Hofstra University, which is on Long Island as well. So spent 99% of my life here. My first year out of college, I went up to Massachusetts to try my hand at college coaching. So coached Assumption College, Division II soccer. Really liked it, but pays pretty atrocious, and you have to work a ton of hours and do other coaching to make ends meet. And I wasn't a big fan of, one, being away from friends, family in New York, and two, youth coaching. It felt more like babysitting. So decided to come back and pivot. I got another coaching job, but I also got a second job as a cold caller at a stock brokerage company on Long Island, and did that for a little over a year. Got licensed, so had my Series 7, my 63, but ultimately knew it wasn't right for me either. Just didn't align with my morals, my values. Wasn't a good atmosphere, so started looking for ways to get out of it and do something else, because it was my first intro into the investment and business world, and I really liked it. So as luck would have it, my mom and my cousin bought a flipping course in January of 2016. And my mom was one of the people I spoke to about ways to leave. And she said, why don't you come check this out? See if you like it. You can do it with, me and your cousin. So went to a weekend seminar, and that was my first introduction into real estate. I knew nothing before that. The example I give was I thought asbestos was a type of mold. And that's the weekend I learned that
It
wasn't true.
sounds like it, right?
Yeah. Well, my reasoning was I knew you weren't supposed to breathe in asbestos, and I know you're not supposed to breathe in mold. So I, in my head, put two and two together,
Makes sense
but
to
didn't
me.
equal four. So, but anyway, so spent the next several months, nights and weekends, getting educated, learning from the course, from podcasts, from books. My mom, my cousin, anywhere I could, networking a lot, going to meetups, and we just failed. Like I said, to flip anything. Never put one under contract. Never bought one. Still never flipped a home. I have one unsuccessful fail to my name down in Charleston, but that's a story for another time. But yeah, so what we ended up learning was it just wasn't the right fit for us in the right area. And we had started learning about investing out of state. So we said, why don't we try to flip houses out of state? But instead of buying another course, we said, why don't we try to partner with somebody that's already doing it, just make less money, but get their experience and, get some hands-on experience. No flipper wanted a partner on the flipping side, but everybody wanted hard money. So we were like, all right, we'll just do a hard money loan to get our foot in the door. Did that for a deal in PA, went okay. But got introduced to his cousin, who's John Cohen, who's one of the owners at Toro, where I work now. Met him. He had started his journey by buying tax deed properties at auction in Philly. So we thought, oh, we'll go down there, we'll buy those, we'll flip them, buy them for pennies on the dollars. Philly's a cool area. So drove down there, drove 50, 60, 70 properties, just my cousin and I. My mom didn't want to go, and we hated it instantly. Came back and we were just like, this sucks. It was super, super rough. It was just very uncomfortable. It was just, a good business model, but not what we wanted to do, just not what we were looking to do. So came back, was just catching up with John and said, thanks, but no thanks. And at the end of the meeting, he was like, hey, just so you guys know, I'm raising money for an 8-unit. If you guys or someone would want to invest in it, let me know, because I need to raise money. And we were like, huh. We kind of looked at each other and said, why don't we do the same thing we did for the flip, but for the multifamily stuff, just we'll invest passively, and our only caveat is going to be, hey, can we just pick your brain, learn more about the process, and do all this stuff? And we figured, rather throw some money into a deal than throw some money to a coach, because at least the deal has the chance of making money. The coach, you've lost it instantly. So did that and just started meeting with them once a week, every other week, coffee, phone calls, whatever. Got on really well and just kept saying, hey, would you be open to joint venturing on deals? We'll take all the grunt work off your plate. You just kind of got to oversee everything, and hopefully we can, grow. And he said, sure. So we actually bought another 17 units in the same area as that first 8 unit, Covington, Kentucky. It's across the river from Cincinnati. Did that. And then we also joint ventured on an 82 unit deal down in Jacksonville, Florida. We're also going to do another 86 unit as a joint venture, but we walked after due diligence. But right around the time we were doing that 17 unit, I was ready to quit. Was talking to John one day on my own, and just really crazy small world. He had actually worked for the same people I was working for about 6 years prior and had quit as well. And I told him I was looking to leave. I was trying to do real estate full time. He's like, why don't you come, work for me and my partner at Toro? And we're working on, 100, 200, 300 unit properties in the Southeast and Midwest. And, we'll coach you up. And I said, sure. So I basically quit the next day, went over there. And it's been 4 years since. And I essentially run the Florida region of our portfolio now. And we've bought, in the Southeast and the Midwest, about 4,000 units, worth a little over 285 million.
Wow, that is great, man. I love your story because it has the ups and downs that is so common in a real estate investor's life. And first of all, the failed flips, don't worry about it, man. Flipping, I don't know those guys. I don't know how they do it, but it's for a different breed. Flipping's a tough game. I did a few, and that was definitely the end of my career there. Mm-hmm. So tax deed models, I kind of want to go back. You were talking about tax deeds and it not being a good fit for you. I've talked to other guys who really like that model for some reason. I've never looked into it myself, but kind of go into why wasn't tax deeds? Why didn't it work out for you in the first place?
So it wasn't the model of the buying tax deeds. It was really just us and the locations of the properties. So one, it was, to get to Philly, it's a few hours there, a few hours back. And you basically have to go every weekend, and you basically have to go both days. Cause it was like, you didn't technically, I think the auctions were on Sunday, and the idea was go drive as many properties on Saturday on that list as you can. Cause the list is just, address and then the price. A lot of times it didn't, if I remember correct, I mean, we did this for all of 3 weeks, so my memory is not going to be that great.
All right.
But I think it was just like the address, the starting bid, and a lot of times they didn't even have like the number of bedrooms and bathrooms or units or square footage or anything, and it didn't have the condition. So you were trying to go there, and basically the idea was if you buy 10, you have 6 or 7 that are in decent condition or in good condition, and you have 3 or 4 that you walk in and the roof is missing, and you just lose your deposit basically, which is a few $100. So you're just trying to make your wins outweigh your losses. But you would try to tip the scale by going and viewing these houses from the outside, knocking on doors, talking to neighbors, seeing if you can get in. Because some of them, it's just somebody didn't pay their taxes and there's a tenant living in there paying every month, and the property is in great condition or, decent condition. The problem for us was my mom did not want to drive down. My cousin was already working 2 jobs and was about to have his first kid. So I knew his weekends were going to be shot soon. And one of those was an agent, and you basically work weekends. So I was like, okay, so it's basically, I'm going to be doing the work for 3 people to drive down to Philly, and I hate it. So why are we going to do this? Like, it was super rough areas. It was just like really, really bad. And we took out some of the worst zip codes. I was just like, I just know this isn't what I'm going to be doing. I just know Chris in 5 years is not going to enjoy this. I don't even think I'll make it to 5 years doing this. So I was like, why go down this route if I'm not going to enjoy it? I'm already in a job that I hate as a stockbroker. Why am I going to go to another job I hate?
Yeah, no, I mean, props to you for making that early pivot, because a lot of people will spend the time before they actually do pivot eventually, when they knew at the very beginning that it wasn't the right fit. And so it's great that you did that before you went too far and sunk too much time into it.
Yeah, I mean, luckily, the flipping took us much longer. It took us 7-8 months. We did the smaller multifamily and kind of pivoted away from that as well into the larger stuff because it was just much harder to do as well. So, luckily that one just happened significantly quicker, but it was also, significantly more obvious.
Yep, absolutely. So I mean, now your failures are in the past. You are now on the road up, which is great. So take us into the multifamilies. You've 8 units, 17 units, and an 80 unit. Sounds
Mhm.
like these have all been JVs. How'd you go about finding these deals?
Yeah. So like I said, the 8 unit was a deal John was raising money for. We were just strictly an LP. So we were a
Okay.
passive investor, and that was just us trying to get our foot in the door.
Okay.
So that was, I think John, it had a buddy, it fell out of contract, brought it to him and said, "You want to buy it?" And he said, "Sure." And then we invested. Um, and the reason we bought the 17 units there was it was the same location as the 8 unit. And the idea was we were basically going to try to burr these smaller unit properties and just continue to, you know, put money in, renovate it, pull money out, and go do it again. And it was basically like the Brooklyn of Cincinnati. And it was, similar to like a Philadelphia with a lot of row houses or small, multifamilies where you can come in and bring a more quote unquote sophisticated approach to a smaller multifamily where you might have a competitive advantage. Unfortunately, what ended up happening was on that second project, the contractor that did the first project stole a little bit of money on the second one. Our property manager also decided to run for public office. So he started doing not as
Wow.
good of a job. And the financing we thought we were going to be able to get was not what we had anticipated. So we decided to stay in all cash because we didn't want to put on what we thought at the time was bad debt onto a property when it was unnecessary. So the first one did okay. It made about 17, 18% in 2 years in an all cash position total. The other ones didn't lose money, but didn't make a ton of money. I think it made like, I don't know, 6 or 7% in 2.5, 3 years total, in an all cash position. So, by and large, the first one, is great, in an all cash position to make 17% from a risk
Great.
reward standpoint is very good. The second one, unfortunately didn't do what it needed to do, but still made a little bit of money. And, from a risk reward standpoint, wasn't terrible. But yeah, ultimately we decided not to continue to buy there because we just didn't have the systems and the people in place that we felt comfortable, expanding as great of as an idea as it could be.
Yeah, absolutely. And expanding, investing out of state it's such a sexy idea because, I live in Seattle. Prices are through the roof. It doesn't
Mhm.
even make sense. You can't buy rentals here because it's just, you're paying $500,000 for something that's going to bring you in, $2,500. So it
Mhm.
doesn't make sense. So yeah, investing out of state it sounds great, but then you get to the point where you realize that you need so many boots on the ground. You need a team or else it's just not going to work. And setting
Mhm.
up that team is definitely the hard part. So you guys kind of pulled out of Cincinnati at that point. Or do you still own those properties out there or are they?
We've since sold them all. I would say at least, how long has it got? I don't even know now. I think so that 17 unit was technically 3 small properties.
Okay.
I think the last one we sold about 18 months ago,
Okay.
give or take. Honestly, I don't even know what date it is today. So,
It's August
um,
21st. Welcome.
there you go. But on your point, you made a really good point about investing out of state. I'm actually on like a mini kick of basically telling people, unless you're in like certain areas and you're really looking for something crazy different, you should be looking within a 5-hour drive first before you go out of state, out of area. And really, you should be looking in your backyard first. Like, unless you're in a Seattle, a New York, or Miami, or whatever, and you want cash flow, you should be looking out of state. If you're, in a tiny town in the Midwest and you want to be where there's more people and there's more growth, I got to imagine there's a city within a 2-hour drive of you that makes sense. So I think too many people are too quick to buy something that's a 4-hour plane ride away, especially when you're in the sub $5 million space. Once you start getting over $5 million and over 70, 80 units, there's enough quality resources that are out there that you can rely on fairly regularly. But when you're in that subspace, it's much harder to find. At least that's been my experience.
Yeah, absolutely. And even I mean, you were mentioning the really high value areas like Seattle, LA, et cetera. Even in those areas, there's some metros, within a couple hour drive from Seattle that still work. So you can still find deals
Yeah.
in your market. You just gotta, you gotta watch out.
Yeah. No, I
um,
mean, I know a ton of people in New York that invest in Pennsylvania. and I've thought about it, but I would just rather I would rather invest in the larger properties that we're doing out of state in other areas than buy my own in Pennsylvania and drive 4 hours. So, I mean, it's really, doing what you know, but I do think there's today too many people are too quick to go to the, 5 hour plane ride away, halfway across the country way without even analyzing what's close by because they hear out of state. And it's like, the whole live where you want, invest where you want. And there's nothing wrong with that, with some caveats.
Yep. Couldn't agree more. Awesome. So that's the 8 and 17 units. Those are both in Cincinnati. And then you got into the big boys. You got into an 80 unit.
Yeah.
So take us through that acquisition. What was your role in that, and how did it go? How'd you find it? What was the purchase price? What was the strategy for exit? All that stuff.
Sure. So that was actually, so it was the four of us, but then we were running a meetup every month for, a few years there. And one of the people there said, hey, if I find a deal in a market that, Toro isn't looking in, can I bring it to you and be part of the partnership? And we said, sure. And one of the areas he started looking in was Jacksonville, Florida, and spoke to a local broker who had a deal that just fell out of contract, and just super lucky. The management company that we knew down there was already managing the deal. So John knew them, picked up the phone, called the owner and said, hey, we just got this deal sent to us. I know you manage it. What can you tell me about it? And the conversation was basically, you'd be crazy not to buy it. It's a great deal. The other owners basically, fixed a lot of the deferred maintenance problems, and there's still a lot of meat on the bones to do unit upgrades and, push rents with, some small operational stuff and some small, cosmetic stuff. So we said, okay, great. So sent it to our lender. It was about just over $3 million purchase. So it was like 47,000 per unit. It was renting for like, I don't know, just under, I think like 650 ish. And it was just in a really nice location. It was like a B- location, right across the road from the naval station there at Jacksonville, which is either the first or second largest employer. And it was just a really clean, simple deal. So we originally thought we put 7-year debt on it. We thought we were going to cash flow it for 7 years and then sell it at like a 7 cap, but it ended up, cash flowing and, selling in 2.5 years for like a 4.9 cap. So we just got super lucky that, we did change our business plan. So we did nicer, we were originally going to do like $3,000 a unit to do interior upgrades. We ended up basically doubling it to do nicer interior upgrades and push rents higher. So that helped increase our NOI, as well as it helped keep the cap rate lower because there was more opportunity there. But also, the market came into effect too. I think we bought it for like a 6 cap, give or take. So, you take any deal at a 1 cap rate and you reduce it by, 1% or 100 basis points, you're going to have a pretty nice day. So we sold that April of this year, right in the middle of COVID, actually, is when it closed. It was under contract for 73 a door. They got a price reduction down to about 70 a door just because of some COVID stuff. And, we sold it after like 2.5 years. It ended up being like a net 22, 23 IRR for our investors,
Wow.
Which obviously was great, unlike the deals in Kentucky. It was just a really great deal all around.
That's awesome. Yeah. Congratulations. That's a recent win for you too. Well,
Yeah.
relatively recent, I guess.
Yeah. No, it was a really great project. It was the first deal that got us into Jacksonville. So, we've bought 1,000 units there, 7 properties. We currently own 5. So not only was it a great deal that made money, it was the first of many and got us into a market that we really like and has continued to do really great things over the past 3 years from a growth standpoint. So, not even just from a financial standpoint, it, led to future growth there as well, which is great.
Yeah, absolutely. So why did you, it sounds, I mean, I don't know, when I'm putting my own hat on, just thinking about that
Do it.
deal that you did, I don't know the actual numbers, so maybe you made $1 billion on it and could have retired, but I would have kept it. So why did
Mhm.
you decide to sell? Was it just did you already have it in your offering memorandum that you guys were going to be selling it at the 2-year mark, or was it just
No,
that there was too much?
yeah, our investment plan was to hold it for, close to the whole length of the debt and then eventually sell. Um, it got to a point where it didn't make sense not to sell. I mean, I think we put on paper like a 15 IRR. So if it had sold at 73 a door without the retrade, it would have been even higher. So it would have been, 25, 26, 27% return. I don't even know. And we were just like, how can we not, don't be greedy basically and say, we have an opportunity to sell. We can make really good money. We can return our investors really good money. And also the way our deals are structured is profit sharing. When you sell a deal for a big number, that's when we make the bulk of our money. So it was also for us to sell to, but we went to all of our investors and said, hey, we think we can sell it for this. We got broker pricing on it. We're like, we think it makes sense to sell. We basically said, we don't know where we're at in the market. And lo and behold, COVID happened. Not that we predicted that by any means, but it was always a concern. We said, we just think it would be smart to, take profits off the table, and, everyone can either reinvest or, do their own thing. And, I would say, I don't think anybody said no once they kind of saw what was possible.
Yeah.
So that's kind of, why we did it. And, luckily I, timed it pretty good or not, I don't know. Obviously a couple months earlier would have been nice. We probably would have gotten an extra, couple $100,000 or whatever it comes out to be. But it is what it is. The question of why did we accept a retrade and not hold it? Kind of group decision. I was actually so there was 5 of us making the decision. I was the largest advocate for holding it and giving them less money. But I understood the reason to sell now and, not be penny wise, pound foolish. So I was okay with it. I just said, I think we're in a great position. I don't think we're going to be in a crazy bad spot in 6, 12, 18 months. And I think we'll sell it for the same or even more. But I also see selling it now. And ultimately everybody else was more inclined to sell now. So we did.
Yeah, makes sense. I mean, obviously it was a good decision. Anything 20 plus IRR is so that's a winner right there. So you guys did great.
Yeah.
So kind of go into how do you guys structure the deal with your investors? There's many different ways to do this. How do you guys go about structuring your own deals?
Yeah. So typically, we'll get debt on the property from a bank anywhere from, 65 to 80% of the value or cost, depending upon if it's an agency loan or a bridge loan, which is like a construction loan. And then the rest will be made up of equity. We co-invest in every single one of our deals, at least 10% of the equity. Oftentimes it's more than that. And then the rest we raise from investors as common equity. And the only ways we get compensated are an acquisition fee on closing, asset management fee every month, and then the waterfall or profit sharing structure on the back end. That's typically an 8% preferred per year, not paid out. If it doesn't hit, it just gets accrued going forward. And then a 70-30 split over that. And then sometimes we'll have a second hurdle at 14 or 15%, and we'll do a 60-40 split over that. So 60% to the investor, 40% to the general partner.
Perfect. Yeah, that sounds great. I was just looked down at the clock and we have already far surpassed the 20-minute mark. I try to keep these around 20 minutes, so I am going to have to cut us short here. I've loved everything you said, though, and I do appreciate you coming on the show. To close us out, we always do the quick question round. These are quick questions I ask you. You give quick answers. Starts with books. One book recommendation that you would do for real estate and one that you'd give just for life wisdom.
So I'm not the biggest reader. I don't read a lot of books. But I would say anybody that's looking to do syndication, Joe Fairless's Best Ever Apartment Syndication book is very good. It's not cheap. It's like $45, I think, or 50 last I looked. But it spells it out pretty well. Full disclosure, I've read/skimmed it, so I kind of know what's in it, but I've never sat down and read every single word cover to cover. But I have looked through it, and it seems pretty damn good if you're looking for a place to start. I listened to Ray Dalio's book Principles. I'm almost done, but it's 16 hours on audiobook, so it's really long. And that was it was very interesting. It was very thought provoking, so I'd definitely recommend that.
Yeah, I've read both of those, and Ray Dalio's book is interesting. That is a good way to put it. Next question, going into your habits. I feel habits kind of underpin our life. They are the foundation of our life. So I'd like to ask you if you could pinpoint one habit that you feel kind of contributes the most to your life. What would that habit be?
One that I think has changed it for me, I have a very, I don't want to say poor memory, but am fairly forgetful. So we started using like task management software, which is Monday.com.
Mm.
And that's been a huge game changer for me personally. Helps me stay on task, helps me get things done, keeps me organized. I've started recently using it to like time block my day. So, the night before, the morning of, I'll sit down for 10 minutes and go through, you know, every half hour, every hour, what I'm going to do during that time. And it just helps me stay on task and not get distracted. So that's been huge for me in the last 18 months.
Awesome. Yeah, I've seen so many Monday.com commercials, and I love their commercials, and I keep like, man, I might want to try that. So
Yeah,
good
I like it.
recommendation. I might actually jump into it now.
Yeah.
Next question is places to invest. Where is your favorite place right now to invest?
So I'm actually in the process of trying to buy a 10 to 40 unit for myself down in Jacksonville, Florida. Um, I just know it really well. And I think Florida is a great place to invest. And I think there's a ton of great markets in Florida, but I think knowing a market can sometimes be more important than the market itself.
Hmm.
So because I know it so well and I've been, looking at it for the past 3.5 years, it's where I feel the most comfortable and where I feel I'll get the most bang for my buck. So that's why I'm looking there.
There you go, Florida, and you are not alone. I know a lot of guys are excited about Florida. So
Yeah.
good recommendation. Next one is last piece of advice. If you could go back to Chris, who was just getting that information from his mom, who you guys were just thinking about going to flips, and give that Chris one piece of advice, what would you say?
Honestly, it's tough because I don't want to sound arrogant, but I don't think I've made a whole lot of missteps. I think a lot of the missteps I made were very important to the learning process.
Mm-hmm.
Um, but I think I tend to be fairly patient, but I'm also fairly impatient to make things go quicker. So
Mm-hmm.
I would just double down on patience, just really, really double down on that. And the importance of doing small short-term things to lead to bigger goals and having that patience at the same time would probably put me further than where I am today. But I don't have anything like massive, unfortunately.
No, patience is. That's a good one. It's really hard to do
Yeah.
well. Really be patient, but once you master patience, it's definitely a boon to the life. Awesome. Well, again, thank you very much for hopping on, Chris. I've had a pleasure having the conversation with you today. And if anybody was listening, watching, and they want to reach out to you, what would be the best way for them to do that?
Yeah, a couple ways. So if you want to email me, it's chris@tororep.com. That's also our company website. So TOROREP.com. If anybody's interested in investing with us, there's a questionnaire on there for investors. Just hit the button, fill it out, and send it along. If you want to follow me on social media, I'm on almost every single platform. You can just go there, search Chris Grenzig, but main one's probably Instagram at chris.grenzig. Or you can check out our podcast too. It's called The Real Estate Investing Experience. You can find it on all the platforms, including YouTube, or you can go to thereiexp.com.
Perfect. And I will grab all those URLs from Chris and put them in the show notes. So if you want to click through there, go through the show notes below, and you'll be able to reach out and contact Chris. Again, Chris, thanks for hopping on. For everybody who's here with us today, thank you guys for showing up. You're the reason we do this. Again, the best way to support the show is just to subscribe, like, and share with your friends and family. Other than that, I hope you guys have an absolutely fantastic day, and I look forward to seeing you on the next episode.